FinCEN recently released a statement on BSA due diligence for independent ATM owners or operators, and it's an important one because it makes it abundantly clear that when it comes to independent ATM owners, the primary concern is knowing the source of cash. FinCEN's statement has a section titled Considerations for a Risk-Based Approach, and the 2021 update to the BSA exam manual has a similar section which is titled Risk Factors. But when you compare the two, the FFIEC includes a paragraph detailing the lack of a consistent regulatory environment where FinCEN does not. And if you take that in context as to changes we've observed from the 2014 exam manual to the 2021 manual and now up through the recent statement, you can see that this actually lines up with how the regulatory guidance has evolved, and that moving towards a more clear emphasis on tracking the source of cash which goes into each private ATM. It's really important because laundering through an ATM is perhaps the simplest and in many ways one of the most effective ways to launder funds. You simply take the illicit currency and stuff it into a machine, and it goes to the bank, in theory, as a simple ACH credit, which would avoid the kind of scrutiny that cash would receive. Now, when you look at the older exam manual, there was really a lot more of an emphasis on that threat environment, which arguably left the impression that all customers with private ATMs are automatically high risk. And on top of that, the old manual included language which one could argue created the expectation that confirming licensure at the state level or the county level was a necessary step for managing that risk. Whereas the new exam manual and the recent FinCEN statement don't include such language. And this is not to say that this is an expectation which shouldn't be part of your program to ensure that you can mitigate your examination risk from your state regulator's perspective. But from a federal regulator perspective, it's no longer part of the playbook and it's not part of the guidance. And reason being is that, again, the emphasis is really on the cash. And as a result, this guidance provides a great opportunity to reevaluate your risk rating methods. But don't simply go into such an endeavor to clear your high-risk list. Make sure that you can really focus on pinning down and evaluating the cash sources of each of your customers with independent ATMs. Now, for example, your institution may classify all customers with an ATM at their location as high risk automatically. However, that may include some customers that have zero involvement with operating the machine or bringing the funds from the machine into your institution. Now, those are particular ones that you may want to revisit whether they're truly worth putting on your high-risk list and having subject to enhanced due diligence on an ongoing basis. Now, on the other side of the coin, your institution may not require some ATM owners to take cash from your institution at all, which is again, a simple but effective way to really prevent money laundering because you're breaking up the trail of the scheme by forcing the customer to take the cash from you as opposed to proceeds from some unidentified illicit activity. Now, to compensate for the risk of allowing the customer to replenish machines on their own, institutions typically will ask a customer to identify their cash source, particularly if it's a standalone location like a gas station or a convenience store. And usually the response back from the customer is going to be the cash source is store proceeds. But this may be an area for folks to revisit. After a certain dollar volume, that level of detail and scrutiny may not really pass the reasonableness test. You have to consider whether you need to have a limit in place, perhaps, or other restrictions that would lessen the number of customers that you have that you are allowing to replenish on their own, because that's really where the risk is. And having a simple explanation of store proceeds isn't very verifiable in a lot of instances. So to reiterate, make sure that your institution's risk rating methodology covers the full range of likely customers you'll encounter, from single locations just renting out space on the lower end of the scale to companies operating numerous machines on the other end. Also, make sure that you're monitoring the ATM credits received and comparing them to the volume of cash withdrawn and resolving any discrepancies that you observe in the process, because those may be suspicious or there may be explanations which can help mitigate the risk that you've initially identified. Another common practice which may make that process easier is requiring a separate account. There, as a result, you can simply take the total volume of ACH credits into that account and compare it to the cash withdrawn, whereas having multiple types of activity all going through an operating account will then force you to find ways to distinguish between those ACH transactions for ATM processing and, say, debit card processing or credit card processing. And lastly, make sure that you use discretion when permitting customers to replenish their machines with a cash source other than your institution. And that's one where you may want to reserve that as a privilege for well-known and established customers, or perhaps set a limit to the dollar volume of acceptable store proceeds as a source of replenishment. And then, of course, if you're banking some of these larger customer types, that may be an area where you have really zero tolerance whatsoever for self-replenishment.